And of course, you could argue we're all responsible for our own world. We live in a capitalist country, and if you're going to live in a capitalist country, you've got to be able to deploy capital to not only support your income through going to work, but you have to invest. You live in a capitalist country, you need to put yourself in a position to invest. You need to get on the ladder. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into household advantage and disadvantage. Yes, does that sound riveting? We're going to talk about Gopniks once again. Yes, who wants a house full of Gopniks as their tenants that can never pay more rent, nor actually your real estate ever grow in value, because no one wants to live in a Gopnik village. So yes, we're going back there, but today, rather than just focus on the socio-economic conversation around the mass affordability crisis in Australian real estate, we're actually going to dig into how to analyze suburbs and work out, using a simple metric, whether a suburb has a decent level of socioeconomics or not. Yes, I'm going to give you one of the professional tips that you can do at home. It's very easy to use. And so you should be able to walk away from this podcast with a tool in your property investment tool belt. We're going to dig into the Household Advantage and Disadvantage Index, otherwise known as IHAD. Yes, IHAD. I had a Gopnik. I had some lemon water. I had a good property. That is really what today's show is about. So welcome back, regulars. Play the program in double speed, get your life back. And of course, all the episodes are actually lessons on real estate, so feel free to go back in time. But hey, I've adjusted my mic. I haven't felt like the past couple of shows, my sound has been very good. So I apologize if you have been offended by my tone of voice. I'm hoping today's show, I'm back, baby. But of course, maybe you've left. Maybe the sound was so terrible, you've decided to find another podcast. It does happen. Maybe I should give up podcasting. I don't know. Maybe it's over for me. I'm a flawed podcaster these days. But let's do it. Let's talk about the Household Advantage and Disadvantage Index. I think it's a great way to analyze real estate. But I think before we have that discussion, we've got to talk a little bit about the problem. And I don't want to harp on about it because it's going to be part of the political rhetoric for the next couple of months whilst we enter an election. Really, the election seemingly is about talking about the cost of living crisis here in Australia. And of course, that cost of living crisis is hurting a lot of households who find themselves in a disadvantaged quadrant. And of course, you could argue we're all responsible for our own world. We live in a capitalist country. And if you're going to live in a capitalist country, you've got to be able to deploy capital to not only support your income through going to work, but you have to invest. If you live in a capitalist country, you need to put yourself in a position to invest. You need to get on the ladder. And I think there was a show on SBS recently, and the Flamingo, he was telling everyone, sort out your life. And I thought that was very good, actually. It's so true. Like, at the end of the day, you've got to take responsibility for your own actions in this world. You can't rely on government. They're menaces. But of course, the best thing you can do is just put yourself in a position to win. And I know it's hard. You know, a couple of kids at daycare, it's $400 or $500 a week. Then you got to pay a mortgage. Then you got to pay the rent. Then you've got, to be able to put food on the table. And then, I don't know, the car breaks down. So you got a couple of grand worth of repairs coming out of the blue. The point of the conversation, though, is you can just live in a state of misery or you can take some action and change your world. Now, I've tried to create a policy to help everybody, both sides of the argument, when it comes to affordability. I voiced it on this show, and I was just up at the shops and I ran into a future member of parliament in my electorate handing out brochures, how to vote. So I had a chat with that person, Jamie. Jamie, if you're there, shout out to Jamie. She listened to me. I said, Jamie, could you please listen to my policy? I want to solve the housing problem for everyone in society so we can all move on with our lives. Jamie listened. Jamie wrote down the policy. Jamie actually gave me her telephone number and asked me to text the podcast through. So, hey, I'm texting the podcast later once this goes to air, which will be in sort of 2 weeks or so. But we'll get it to Jamie. She was quite keen to understand this theory. I'm going to call it the Saggers theory because that's how I promoted it to Jamie to pass on to really the cabinet and those more senior to her to kind of have a look at this as a policy. Now, obviously, we've got an affordability crisis if you don't do anything about it. If you deploy capital, really, you don't have an affordability crisis because you've made a lot of money. As inflation unfolded over the last 3-4 years, some people really have beat inflation hands down. Painter bought a property off me in Southeast Queensland, bought it through our investment organisation. We put the deal together for him, bought it for 600. Now it's 1.2 million in 4 years. It's gone up 600,000. It doubled in value in 4 years. Do you think that person has a problem going to Coles and paying extra for eggs? No. The short answer is no. They have beat inflation. However, of course, if you're uninvested in a capitalist country, you're going to run into a problem. You're going to pay the piper. And really, that was well articulated by the Flamingo, that you're going to pay the piper. It's not free. Nothing is free. Going to the doctor isn't free. It may appear free, but it's not free. Someone pays for that. Someone pays for everything, and it will catch up with you if you do nothing about it. So anyway, the policy I gave Jamie, who was a lovely lady, she listened to me. She thought the policy was very good. It was pretty simple. In America, you can defer capital gains tax. So if you sell a property, you've got to pay a capital gain. However, in America, if you go rebuy a property in a certain period of time, you can defer the capital gain. It rolls over to the next property, and until the next property is sold, the capital gain is not payable. And of course, if you can roll it over again, you can roll it over consistently if you, as an entrepreneur, a property entrepreneur, provide a property to the rental marketplace. And of course, I was explaining to her that many people have a capital gains lock. They can't sell their property because they're just going to pay a lot of money. I explained the property I've got. It's got, I guess, a lot of money in it. If I sell the property and return it back to the established marketplace, I will cop a huge capital gain tax. And if I was to even go and buy a new property and start over, I'm behind the 8 ball because capital gains tax, once you discount the 12-month concession, it's still sort of 23.5%, 24%. So I need the next property I need to buy needs to perform at a 24% capital growth rate in a short period of time, plus stamp duty, call that another 3%. All of a sudden, I need to make 30% out of my next deal by selling the deal that I have already made money out of. So I explained to her that there's plenty of people like me that would do that. And if you could just defer the capital gain. So the argument is, well, if you just sell established supply and rebuy established supply, you're not producing another property. So I explained to her, well, you could actually do it a different way, where you sell established supply, you get a deferral of capital gains as long as you go buy new construction. And you've got 12, 18 months to go and find the right property in new construction. So you sell an older property, return it to the housing market, young family in a nice location buys that property. They now have their first home. But of course, me selling that property removes a tenant from the rental market. But if I had a deferred capital gain and I could go and buy a new property and I could use all of my money, I've got 100% of the money that I've made from the property, the actual cash. I've got a tax liability I'm deferring. I can now afford to go and buy a property and supply it to the rental market. And of course, because we need new supply, you could link the deferral to new supply only. And of course, that creates one property entrepreneur providing two properties to the marketplace, one for a tenant and one for the home buyer marketplace. Very simple policy. I've thrown it out there so we can just move on with our lives and get on with other things than talking about the affordability crisis. But hey, there are people in a disadvantaged space, so to speak. Certainly when it comes to statistics. As the Flamingo said, we're all responsible for our own world. Like, go do a Tony Robbins course. Like, go sort your life out and you'll probably get much further in life than sitting around wallowing around just how hard it is. There are so many people who can take action for themselves. But as a property investor, I know the reality of that is not going to happen. Most people are not going to focus inward. They're going to focus outward. They're going to blame the government. They're going to blame society, blame their neighbors, blame how they went to school, and go into that sort of self-loathing victim situation. And I know it is hard for certainly many people in society. I don't want to take a position where it's a complete fallacy that some people don't do it tough. Some people absolutely do it tough. Some people struggle and have put themselves in a position where it's almost impossible to get ahead. So because we know a lot of society is in a position where it's impossible for them to get in the head, as a property investor, I don't really want to park my investments nearby that cohort. I just think it's a hiding to nothing. It's a race to the bottom. As a property investor, I want to invest in assets which grow, which get capital growth, but also get rental growth. A great way to analyze suburbs and places and people is IHAD, the Household Advantage and Disadvantage Index. So socioeconomics is really the concept we're talking about, how social structures are arranged in society. And common pitfalls I kind of see with investors is really forgetting tenant profiles, for example. They might buy a half decent property, but it's in a suburb where the tenant pool is pretty well broke. And despite even having a half decent property, they're not going to get rental growth because their half decent property is just disconnected from the right socioeconomics. I also see that people sometimes turn their nose up at a gentrifying area, which is trending and improving, where a new social economic status, a new gentry, if you like, is moving to a suburb and improving that suburb. But because it's not branded as a great place, people kind of turn their nose up at it. But I also see that in every area of Australia, there is a level of disadvantaged people, disadvantaged streets, disadvantaged places. And so real estate is very niche. It is very street level, if you like. Even in the most affluent places, in some suburbs, you have a pocket of housing commission. You have pockets of challenges, socio-economic challenges. And it was really just about sort of pulling that data apart, just seeing if we can avoid some of those challenges and find ourselves the right real estate. Now, I mentioned this the other week on a previous podcast. For you to be successful in real estate, another buyer must pay more than you into the future. How are they going to do that if much of society is struggling to afford the cost of living today, and we're going to live in a more inflationary environment where deflation, going back to zero interest rates, is not an option? How is someone going to be able to pay more for real estate, whether through rent or through capital appreciation, than you? This is the big question. I did a whole podcast on this, the idea of finding a consumer surplus equals capital growth. But when I did that podcast, I talked a lot about local income ratio, or the neighborhood effect of really who's in the neighborhood and what is the socioeconomic status. If the socioeconomic status is improving census to census, and the socioeconomic status of a neighborhood, a suburb, if you like, is improving, and it becomes a multiplier effect. It attracts more people to come to that neighborhood. Socially, status-wise, human beings generally want to hang out with people similar to themselves. They don't want to, if you're not a Gopnik, you don't want to go and live with Gopniks. If you are a Gopnik, you're probably pretty happy living with fellow Gopniks. That's the nature of socioeconomic status. So when a suburb has a social status, it creates a halo effect of more people wanting that social status. And of course, a very gentrified, almost turbo gentrified place, suburb, has a status that is unrivaled, and anyone with money wants that status. And you could argue, say, the eastern suburbs of Melbourne and Brisbane and Sydney and places like that, you know, the status of living there is very, very high. The status of living in Bellevue Hill in Sydney is as good as you can get. So for a suburb, it creates a magnifying effect of pulling people in, not pushing people out. So we kind of want this halo effect on our suburb, but we also want inside the suburb, for that halo effect to happen, inside the neighborhood, we need people to improve their social status to attract others to want that similar social status. And between the two tectonic plates meeting, neighborhood effect and halo effect, you get an improvement of people, place, and property values, both through capital appreciation and rental performance. So the ABS, Australian Bureau of Statistics, came up with a way to analyze places and people in those places. And that is known as IHAD. Yes, IHAD. It's very simple to remember, isn't it? I'm drinking lemon water now. I'm just love lemon water. I now chop a lemon and put it in a giant beer cup and put tap water in it. That is my new system. I had a lemon water. I had a look at a property suburbs socioeconomics. Really simple to remember. So the index, if you like, the IHAD index, really sort of is a baby of CIFA, which is basically a social economic modeling that the Australian Bureau of Statistics use to break down socioeconomic advantage and disadvantage. And really, if you want to understand how to use the index, it's about identifying growth areas, avoiding investment pitfall areas, and targeting properties that align really with your financial goals that are not going to be undone by socioeconomics in society. And so it matters for investors because what we want to do is, from census to census, identify undervalued areas, but areas which are improving. And we can find places which once were disadvantaged, but are now containing affluent pockets and affluent households. And this means there's higher incomes coming to the suburb and potential for change and improvement. That's really the gentrification effect. But we also want to look for a high IHAD rating to target tenants, to target a higher profile of tenants that you can put the rent up. Remember, rent gap theory is about, well, how much can tenants pay based on their income profile? If you've got a tenant income profile where everyone in society is paying, they're all earning $50,000 a year and paying $30,000 a year in rent, it's going to be very hard to put up the rent, right? So if we can align our neighborhood purchase with the right targeted tenant profile, that also helps with where we want to go. We want to go to the end game in property investment, which is effectively income in retirement, or trading capital growth in retirement to go and buy income. You could sell down real estate and enter the bond market when you're older, which is basically bulletproof. You can get out of real estate and get a 4% Australian government bond and basically turn your millions in real estate into an Australian government bond. So now I've just ruined my light. Let me fix that. I just kicked it, but it's back on. Wow. We've had everything on the show today. Yes, my urban property investor light just basically went off. Now it's back on. But let's not waffle. Maybe I'm waffling. Are you finding I'm waffling? Could be. Let's speed it up. Oh, I've got an itchy foot. So how the IHAD is constructed by the Australian Bureau of Statistics, it looks at, for example, percentile in a neighbourhood of public housing renters, basically the low rent quartile or low rent payments, households paying less than $250 a week in rent. So what proportion of them are in a neighborhood? Low income households, what proportion of households through the ABS census are earning below $26,000, which is like, virtually nothing. That's basically living on Centrelink, living on the pension, that kind of thing. So low income households, but also it looks at educational attainment. And so households where literally people left school in year 10 or below. And so they are not necessarily educated to, um, get a job which is reasonably paying or six figure kind of income. I mean, it can be done. People don't necessarily need to go to finish school and go to university and so forth, but it's just an index. If you've left school in year 9, maybe you're working in a shop or something like that. You're not necessarily, working on the ASX 200. Unemployment measures, basically the participation rates and who's going to work and who's not going to work. It looks at basically private transport, who has a car, who doesn't have a car, and it looks at retirees that are renting, so elderly tenants without home ownership. It puts them in a suburb matrix. So you can imagine, like, one of the challenges one of the early properties I bought, I wish I had studied IHAD, because I bought a property and really the majority of that neighborhood was elderly tenants without home ownership. And trying to put up the rent on an elderly 75-year-old is a very, very difficult thing to do. Not only is it you get some sort of moral kind of problem internally, like you feel a bit, this is not nice, but equally, because the pension is so low in Australia, they really don't have money to pay more. So if you can avoid public housing, if you can avoid the low rental pool of people, the low income pool of people, the low educated pool of people, the higher unemployed pool of people, and the pool of people that are lacking the ability to escape through not having a vehicle, as well as that elderly tenant marketplace, you will do yourself a favor. I've been there. I've got the lashes on the back. Don't do it to yourself. It is usually inexpensive property, but inexpensive property for a reason. And sometimes when we look online, we can, particularly with regional areas, you can look in regional areas and you can find a property for 180,000, 250, 310,000, and it could be surrounded by this issue. And so that's not necessarily going to work out long term. Maybe over the short term you might win because other people, greater fools, are buying the same thing around you. Everyone's rushing in. We need an affordable property. You need to become a property investor. And all of a sudden, the music stops, and those type of properties can get you a little hit, but they don't really do much over the long term. So just be mindful of that. Now, when it comes to the advantage, what's the opposite to disadvantage? Well, high household income, earning above effectively the Australian average, which is $90,000. Now, average and median are two different things. Remember that. Year 10, mean, median, mode. Average is a lot bigger than median. Median in Australia is less than 70,000, which is the midpoint of what the most people earn in society. Average is a little bit higher. So high income households, which, some would argue doesn't feel like a high income, $90,000, but that is, according to the ABS, the statistic they look at. So the majority of households earning above that number. Multiple cars. So that means people can move to jobs, they can get around, they can get to rapid rail, they can get to the right pockets to work. Larger homes, So properties or suburbs rather with 4-bedroom properties and more. Higher education, so households where there is a member of the household with a bachelor degree or higher. So well educated. They could be gopniks themselves, an educated gopnik, but they are educated. And those with high skilled occupations, households where at least one member is in a high skilled profession. And so they are generally those tier one, like workers, where they're very smart, they're very educated, and they can earn a lot of money. So most of the suburb as well is either now debt free or is paying a decent mortgage on a house or a property. And so let's look at the lower socioeconomic. Again, public housing, low rental pool, low income household, low educational attainment, elderly tenants without home ownership. The higher one is high income household, multiple cars, larger homes, educated, highly skilled occupations, and also able to pay mortgage repayments without default. There's no mortgage arrears. So using IHAD for real estate investment as a strategy is all about picking the right locations. If you're a buy and hold investor, you can go and explore a market, and if it's maybe it doesn't have the best IHAD score, but right next door a suburb does, and so you're going to get that ripple effect. Equally, maybe it does have a good IHAD score, and that's a home run. Maybe it's perfect the way it is. But obviously, in general terms, the better a socioeconomics of an area is, the more expensive it's going to be. So we've just got to also pull the strings and try and understand the urban world to try and find a high IHAD area, which is going to get better capital growth and better rental growth as well. A low IHAD area can generally provide a higher rental return because the purchase price of the property is lower. But it's lower for a reason, because no one wants to go into that neighborhood. So you just being very mindful. Sometimes a higher yield is actually disproportionately not a higher yield. In other words, a $200,000 property with rent of $300 a week looks like a high yield, which technically it is. But why is it a $200,000 property? Why isn't it a $700,000 property? Will a $300 a rent week ever become a $600 a week rent? Conversely, if you go up a tier of socioeconomic status, the $700,000 property with a $700 a week rent in the right IHAD area, the $700 a week rent, even though it's a lower yield than the previous example, can go on to become a $1,400 a week rent because of the nature of pockets of advantage versus disadvantage. So, when it comes to understanding how IHAD kind of works, obviously it's all about factors such as income levels, employment status, educational attainment, housing circumstances, all of that. But the way it's rated is you've got quartile 1, 2, 3, and 4. 1 is the lowest socioeconomic status, 2 the second, third the third lowest, and fourth is the highest quartile. So it sort of goes 1, 2, 3, 4. So 3 and 4, obviously much higher than 1 and 2. What's interesting, if you look at a state level, the IHAD status, you've got, for example, in the Australian Capital Territory, which isn't a state, but let's just call it a state, 48% of residents of the ACT of Canberra basically earn more than $90,000 a year, have a great job, and have the right educational qualifications. So obviously a lot of that pool is working for government. So 48%, it's huge, huge. And it's easy to see why the Canberra property market in general is one of the most expensive real estate markets in Australia, because its internal people are highly skilled, highly professional, highly paid people. And so it is absolutely a large percentile of that marketplace. And every deal I've ever done in Canberra, and I've done many deals in Canberra, I've always made people money. I've got 100% track record in Canberra. I wish I could say that for every marketplace I've done investments in, but absolutely, one of the reasons is the income profile of the community is so robust, so robust. Not everywhere, but when you get to the bottom of it, a lot of high yields and high income people. There's no real broke end. There's no Gopnik end of Canberra. Well, there may be a Gopnik or two. But if you look at Tasmania, Tasmania's fourth quartile is 23.4%. It's actually double in the ACT than it is in Tasmania, which is quite interesting. And if you look at even the Northern Territory, it's higher than that of Tasmania. So probably outside of your Hobarts and Launcestons and so forth, there is a much people aren't necessarily smashing it. And so, yeah, very interesting. And so Tasmania's actually got a very even profile. It's got almost everyone's at almost 25%, 25% quartile 1, 2, 3, basically 4. Quartile 3 is a bit higher than 4. But if we look at quartile 4, which is the highest income or the highest educated households, the highest, best jobs, it's definitely in the ACT. Victoria, 35%, really good. New South Wales, 35% as well. Queensland, 30%. South Australia, 28%. Western Australia, 34%. Tasmania, 23%. Northern Territory, 26%. ACT, as I said, 48%. Other territories, 16.1%. So they would be Australia's overseas territories, by the way, which I often frequent. The Norfolkian, people of Norfolkian, 16.1%. So Australia in general scores around 33% in quartile 4, which is that, obviously the more, that if you see an area and it's got more people in quartile 4, it's probably a very good area to invest in. That's the reality of it. So you're never going to have just 100% in quartile 4. It won't work like that. Even in wealthy areas, there's quartile 1, 2, 3, and 4 in the neighborhood. But if we look at quartile 1 and then look at the highest percentile of suburbs in quartile 1, they're all in Indigenous areas. So if we look at the Torres Strait Islands or the Tiwi Islands or West Arnhem Land or East Arnhem Land, you've got basically up to 90% of people basically in that low quartile space. In other words, probably on government subsidies. And it is what it is. I don't know, if I lived in the Tiwi Islands, it's a great place. I'd probably do the same thing. Just go fishing and be happy every day. Why conform to society when you can forage the Tiwi Islands? I get it. I get it. As a little nomad myself, I could easily live the Tiwi way. But if we look at areas where there is, again, high educational attainment, professional skills, and a lot of people in a higher IHAD quartile, you've got gun places like in Brisbane, Fig Tree Procket. You've got places in Sydney which are really high IHAD. High IHAD, a bit of a tongue twister there. It's quite interesting, that Northern Rail line. You've obviously got a lot of people that are knowledge workers now living in Sydney's Northern Corridor, places like Kellyville, Schofields, Castle Hill. They're really, really good areas. They're a little bit further from the city, but what it is demonstrating is they're very educated areas, and probably a lot of them are driven off the back of the new Australians coming with degrees and earning a half decent amount of money, and moving to some of those sort of growth corridors and just lighting them up. Which, again, you see the gentrification in some of those growth corridors, and the results through housing and growth and property values increasing. So it's quite interesting. And of course, you've got some big numbers there in places in Canberra and so forth. So the highest score in Australia at Australian level, remember, is the Australian average is 33%. The lowest quartile with the highest score is basically an Indigenous community at 93%. But then the highest quartile with the highest score is in Canberra at 65%, a suburb in Canberra at 65%. So the other way to look at it really is to overlay, say, the participation rate with the IHAD rate. Now, the participation rate is the employment rate in Australia, where the participation rate is how many people work. And at the moment, there's 4% unemployment, around 67% that are participating in work. And so you could easily go, well, okay, I'm going to look at the employment, how many people are working, and then apply that to a suburb and go, well, hang on a minute. Wow, there's 65% of people in this 65% of people in this neighborhood are in the fourth quartile, earning a lot of money, and the participation rate is 67%. That's basically 99% of people are like going to work and crushing it. And again, their incomes can be extracted by a property investor through capital growth and rental growth. And so just a nice way to look at it. You could look at the best suburbs, and most of them won't have a 65% rate. But what we're looking for is a good balance of effectively quartile 3 and 4 people over quartile 1 and 2 people. If the majority of people are above the middle, sort of, you could say above middle class, you're going to have a swing of, and the property values are right, you're going to do really well. It's why I look for typically affordable yet highly livable neighborhoods. Affordable in price, highly livable in esteem value, that get a decent IHAD rating. All right, folks, that's it for me. I hope you now know how to understand socioeconomics and maybe avoid those gopniks. All right, folks, take care. We'll talk again soon. That's it from me. I hope the sound was better. I've fixed my mic to be better sounding. Hopefully you're still listening and you haven't, given up on the show. But hey, that's it. Uru. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.